I had to sign a bunch of security stuff in now. I'm going to assume my. Can someone say something? I just want to make sure my speakers are working.
Hello.
Oh, now they're working. Okay, thank you. I keep getting these error messages. Okay, let me. All right. Tonight. Chapter 6 handout. We may finish the Chapter 6 handout. I'm not sure. Sampling overview. We should finish this. Not too much left on this. That's not how you spell finish, by the way. Adding letters. That's what I'll do. I give you guys your money's worth. I'll add extra letters in there for you guys. All right. So today, I know what I wanted to show you. First of all, this is from last class, Chapter 6 handout. And we talked about when you get getting a client and you're talking to the old auditors, kind of things that you look for, talk to them about. But I also mentioned this 8K report, and I actually have one. It's an old one. It's how old is it now? 2014. Hey, that's when I was born. All right, so this they're all the same anyways. But an 8K report, what it is whenever there's a major change in the company, it doesn't have to be a change of auditor, but whenever there's any a major change in the company, they file an 8K. So for instance, if they buy a competitor or something like that, they fill out an 8K. If their chief financial officer leaves the company, they fill out an 8K. If they get a new chief financial officer in, they fill out an 8K. So an 8K is whenever there's anything that's significant that happens in the company, you have to let the Securities and Exchange Commission know about it. And one of those things is if you get a new auditor, you're a publicly traded company, you get a new auditor, you have to go ahead and fill out an 8K saying we have a new auditor, so it's a change for the company, and you send this in. And the 8K is, like I say, it's a kind of a generic form because it could be used for a lot of things. And in this case, it's what is this? Honeywell and change of auditor. You can look these up. Sometimes companies will have dozens of these every year. Blah, blah, blah. Oh, this is kind of important. Okay. One of the things about filling out an 8K for auditors is a little bit different is that if there's any disagreements within the last 3 years, the company has to list those on the 8K. So any kind of disagreements they had, significant disagreements with their auditors, they have to have that on the 8K. Now, the way it works is, how does the SEC know that they're telling everything? Well, the SEC will send that 8K report to the auditors, and it's a yes or no. Is this everything? If it's a yes, then everything's okay. If it's a no, and again, it's yes or no. If it's no, they send the 8K report back to the company and say, look, you're not telling us something, fill in the rest of it. So if there is something missing, and again, the auditor doesn't volunteer that information. That information has to come from the company filing. So it's a little bit different than some 8Ks. Some 8Ks are just, here's the change, where this one is, here's the change. There's no significant problems within the last 3 years. Or what were the significant problems within the last 3 years? You have to list those. Okay. Nothing too crazy here. And a lot of times these things are only a page or two long. So they're not that extensive. Okay. All right, let's go through these. And client accepts some questions. The attempt to communicate between the successor, this is the new auditor, and the predecessor, old auditor, to be initiated by the, which one? Who has the obligation to start that communication?
The successor?
Yep. Yeah, the successor, the old auditor is under no obligation to, they may not even know who the new auditor is until they, until they contact them. So yeah, the successor auditor is the one that has to initiate it. And the attempt to communicate should be made before or after the audit is accepted.
Before?
Yeah, and the idea is that you should know what you're getting into. And the successor, the predecessor auditor is probably the one who knows the best. Okay, the successor auditor, now there's a number of these will be you want to do. Would likely inquire about which of the following. How about A, yes or no?
Yes.
Yeah. Yeah, you want to know if there's any disagreements with management, ask them, or any problems. Specific audit program steps. That one probably not. You're going to have your own audit. You're going to do it your own way. Unless there was something really unusual, you probably would not talk to them about, certainly about what the steps were. But if there was a disagreement with management, you might ask how they came up with that or why they think that. Any just general communications with management? Yes. Yeah, you're right. It's yes. Yeah. Any regular communications with management? You might even ask them like, who do you actually talk to? Because sometimes it's not exactly clear who you should talk to. D is an interesting one. It's yes, by the way, but this is not on the 8K. Even for a publicly traded company, this is not going to be on the 8K report. One of those, I don't know, it's not necessarily strange, but the reason for the change in auditors, that is not going to be on the 8K. The 8K does not ask why are you changing the auditor. You're just telling them you're changing it, who the new auditor is. That's all that's going on when you file the 8K. Excuse me, but you don't, on the 8K, you don't get a reason. So even if it's a publicly traded company, you say, well, I could look on the 8K and find that. You can't find the reason for the change on the 8K. And so you'll ask the other auditor. And it could be any number of reasons. One of the things that came about is when the Sarbanes-Oxley rules came out and they could no longer do consulting. Basically, a lot of the consulting stuff they used to do, they could no longer do if they did the audit. You had a bunch of companies that were giving up the audit. Let's say they charged, $2 million for the audit. Maybe they charged $28 million for the consulting. So they were more than happy to give up the audit and keep the consulting. So a lot of times you have these changes of auditors, and the changes really came from the auditors themselves. Okay, we don't want to do your audit anymore. We just want to do the consulting. And so that happened a lot. So there could be a number of reasons why they change auditors. Okay. This next one is a big one. Communications with those in charge of governance. And this, wait, this is yes. This term governance is a big one for the AICPA. Whenever they say governance, they're talking about the board of directors or audit committee or other committees with the board of directors. Oops. So whenever you see governance, that's a key word, and it means the board of directors or audit. How about F? Reasoning for specific testing of accounts.
Yes.
Probably not. You're going to figure out what accounts you need. There's going to be a whole process, and we'll talk about that in a little bit, of how you come up with what needs to be done, what needs to be tested, and yeah. Integrity of management.
Is that yes?
It is yes. And the AICPA would say this is the most important. It's most important T. Okay, that's probably not a word. It should be a word. This is very important T. Yeah, integrity management. AK report, I didn't go too much into this. I'll kind of answer most of these. Change into auditors, obviously that is yes. You change an auditor. Reason for the change would not be in there. Fee amounts would not be in there. D and E, significant disagreements over the last 5 years, or E for the last 3 years. Which one is it? I think I told you that. Did I? Maybe I didn't. It's 3 years. So it's disagreement over the last 3 years. And the predecessor's response will also be in there, and it's usually they agree with, because they have to come back and say that they, it's thumbs up or thumbs out, yes or no. So the response is that they agree with those is before I'd say we even release is going to be in there. I think it's let me see if they should have it. Wrong thing. Yeah, these are some of the responses that they put in there, but this is yeah. But generally they have to show everything about what they are. Okay. Which the following is considered to be important? A, reputation of the client's directors, officers, and management.
Yes.
Yep. Probably the most important thing. ACCT. Nationality of the owners.
No.
Credit rating of the client. This is a tricky one.
No.
Actually, it's going to be yes, and I'll tell you why. It may have something to do with the risk of the audit, the overall risk. Someone who's doing poorly financially may be in a position of, not to say that they would be dishonest, but they certainly have maybe more of an incentive. Okay, marital status. Probably not. There's something crazy going on, a fight or something like that for the control of the place. Pending litigation would definitely be something you want to look into. How about independence of the auditor to the client?
Yes.
Yep. Chapter 3. We just had the test on. Yeah, so that would be the. Oh, by the way, your extra credit points are not added into your test yet. I should mention that earlier. But they will be. Auditor's competence in the client's industry.
Yes.
Yeah, it's a consideration. Now, it doesn't mean that if you don't have a competence in the industry, if you believe you can obtain that competence, and whether it's hiring people or doing research or whatever you need to do to get to that level, you can still take the audit. And I think I mentioned before, it'd be ridiculous to become an expert in auditing whatever a mining operation. If you didn't have any customers, no clients that actually did mining, why would you, know how to do that? On the off chance that you get a mining client. So if someone comes to you and they happen to own a mine and you want to do their audit, you can, as long as you feel that you can get up to speed on the specifics of that industry. There's no problem with doing it, but it still is a consideration, and you might come to the conclusion that no, we can't do it. It takes a lot of specialization or something. Maybe we can't do it. So it is a consideration. Okay. Establishing understanding with the client. The engagement letter. Okay. There's a lot of stuff in this thing. So what goes into the engagement letter? Basically, it's similar to being it's a contract, basically. It's a contract. It does usually have a little bit of wiggle room in it. We'll talk about that in a second. But it's basically getting an understanding with the client. And I'm sure you guys have had business law or some kind of law class where they talk about a contract being kind of the meeting of the minds. In other words, you expect that this will happen, and there's a lot. A lot of times there's a contract. It's possible they don't have a contract. It is possible that you don't have an audit engagement letter. It's highly recommended, and it would be a kind of unusual not to have it. But generally speaking, yeah, it's a contract, and it's basically getting an understanding of what it is that you're going to be doing. And a lot of times, especially if the client has never been audited, they have no idea. Yeah, you tell them you need their tax returns, and they, why? I'm not going to give you my tax returns. You have to. We need your bank statements. You're not going to get my bank statements. Yeah, we have to. A lot of times they just don't understand what it is, and so I worked with a guy. I think I told you that we did the audits, and every now and then you get a client that would come in and say, like, I need to get this audit for the bank wants this audit thing done. It's like a piece of paper that you got to fill out, and they have no idea that it's like, okay, yeah, it's, we got to do a lot of work to sign that piece of paper that the bank is asking for. So a lot of times, it's kind of getting an understanding with the client, especially if they haven't been audited. Okay, some of the basic stuff, what the auditors are going to do. Big things are talking about materiality, reasonable assurance. They may think that you're looking at every single thing when you're not. You're not giving absolute assurance. And inherent limitations of internal control we haven't talked about. We'll talk about that. And this is chapter 7. You talk about their responsibilities. They must provide you with all the information you need. They're responsible for financial statements, internal controls, and they're also, this is a big one, $5 with access to all relevant information. So you tell them, look, there's things we're going to be asking for. Document retention. This one, this shows up in the CPA exam every now and then. Hey. AICPA, you must keep the documents, the work papers for 5 years. PCAOB is for 7. The audit work papers are owned by the CPA firm. The client does not own them. They don't get them. Sometimes the clients say, well, I want the work papers at the end of it. They're not yours. They're ours in case we have to go to court. This is going to be our evidence that we did what we were supposed to do. So the work papers are kept by the CPA firm. They have to be kept for at least 5 years if they are for the AICPA, and at least 7 years if it's a publicly traded company. Financial statement agreement with other management documents. We'll talk about this in chapter 18. Actually, chapter 16, I think. It's either chapter 16 or 18. Shouldn't I know that? I should know that. And that's basically if they have something in their annual report that is not the same as their financial statements. Okay, blah, blah, blah. Oh, internal auditors. This is what I used to do. It might sound kind of strange, but external CPA firms a lot of times rely heavily on internal auditors. Internal auditors, like I was, we go around and we know everything about the company. We know way more about the company than the external auditors do. So the external auditors, remember, they're only coming in for 3, 4, 5 weeks or whatever it is. They need get all this information. A lot of times they'll rely heavily on the internal auditors to get the information, to help them do the audit, and to any insights that they have. And they're coming in. Let's say they have 6 days to do inventory. Well, I can remember I was helping them one time, and one of the big plants we had, we just did 6 weeks on inventory. I was on the inventory part of the audit. So think about how much more time you have and how more thorough you can go through stuff if you have 6 weeks compared to 6 days. So a lot of times they'll rely kind of heavily on the internal auditors. If a company has internal auditors, if they're big enough to have internal auditors, a lot of times they will. And if you work as an internal auditor, you're probably going to be, for a publicly traded company anyways, you're probably going to be working with the external auditors. Some people on the audit staff don't like it. I liked it. I don't know. It's kind of interesting to me. But yeah. Okay, time budget. Interim work can be done before the audit. And if you think about it, if you're doing an audit of a company for their entire year, this interim work, for instance, you could do the audit, of the sales from, I should say sample. You could do this. You could come in November and do some of this work. There's nothing wrong with doing that. Say, okay, we're going to do the, look at the sales from January to October, and then when we come back at year end, we'll just do November 1st through December 31st. I know what the months are. November 1st through December 31st. And then year-end audit work, things like inventory cutoff. Inventory cutoff, sales cutoffs, those are probably the two biggest ones. Taking the inventory and then also looking at the sales when they cut off the sales. Okay. Audit planning, first year consideration. So here we have an income statement. Which of the following amounts on this income statement crazy there. Let me space this out a little bit better. Okay, so here we have the total goods available. We have beginning inventory plus our purchases, so this is what we have available to sell. Our ending inventory, this is what was not sold, right? It's still sitting there. And so we came up with a cost of goods sold of 4,100. We have some operating expenses. Out of all these accounts, let's focus on the inventory. Out of all these inventory accounts, at year end, which one would be the hardest one to prove? Out of these, which one would be the hardest to prove? At 12/31. Anyone? So of these red, I think these are actually maroon or something like that. Of the reddish ones, which one would be the hardest to prove? At year end. Which one?
Purchasing?
Close. Purchase would probably be the second hardest. This beginning inventory is probably the one that's going to be the hardest to figure out, because you think about it, you can't just jump in the time machine, go back a year and see what the beginning inventory was. Now, if you planned ahead and said, okay, we'll come in and just audit the ending inventory from the previous year, and that'll be the beginning for this new year, that's fine. But a lot of times the first audit, you don't look, especially if it's material. Look, we don't know what your beginning inventory was. And what your beginning inventory was has an impact on your net income. So we cannot give you a clean audit because we don't know, especially if it's a material or a significant amount, what the beginning inventory. So this one is the problem. This one right here is the problem. Oops. So much of a problem I can't highlight it. So this one is a problem. So the beginning inventory, we don't know what it is. And if we don't know what that is, we don't know what the goods available are. This also is unknown. Ending inventory, we know. This is known. But we don't know the cost of goods sold because it's based on this unknown. So this is going to be unknown. And in the end, the cost of goods sold will be unknown. Gross margin's unknown. You get the idea. Okay, so when you have a material count that cannot be verified, what kind of a report do they usually get? There's actually two of them that they have the possibility of getting.
Is it the adverse and the disclaimer?
Close. The disclaimer is probably the one that most people would think about. You might give them a qualified. Qualified just says there's something material, but it's only one account, in this case, inventory. We don't know what it is, and we don't know what the impact is on the other accounts. Inventory might be a little bit sticky to do for qualified. It depends on how material it is. But anyway, those two are the ones that we had to look at. And this one is probably the one that most people would think of, is the disclaimer. You don't know what it is. You don't know how bad it is. It might, you don't know. It's a shoulder shrug. That's what that one is. Okay. Now, here's where it gets a little bit interesting. The ACCT requires that they put it on the financial statements as a whole. Oops. Okay, so it's possible that you give a disclaimer on all of them. So say, okay, we don't know, taken as a whole, we don't know any of these financial statements. It's also possible that you split up your opinion. And you might say, look, we're going to give a disclaimer on the income statement because we don't know what that one is. Income statement goes into statement retained earnings. Again, we don't know exactly what that one is. However, the balance sheet, we might give it unmodified. Statement of cash flow uses the income statement, so this will be A. So it is possible that you actually split it up and say, okay, everything's getting a disclaimer except for the balance sheet. And the balance sheet is allowed to do this because the numbers are all at year end. So you can look and say, okay, we know what the ending inventory is. we did an inventory and we know what the ending inventory is. That's fine. We know what the cash is. We know what the accounts receivable are. We know all the stuff. So because the balance sheet has all those balances are at the end, it's possible that you give a disclaimer for income statement, statement of retained earnings, and cash flows. Those are all dependent on the beginning inventory, but the balance sheet is not. The balance sheet only has the ending inventory on it. Has the ending cash. You can figure out what that is, the ending equipment and all that kind of stuff. Accounts payable, all that. So you can split it up. And you say, well, why would you do that? Why don't you just give a disclaimer for the whole thing? Well, these are your clients, and you're trying to do your best for them. And a disclaimer is really nothing. A disclaimer is, you can imagine how irritating that is. Here's our bill, but they can take that to say the bank and go, okay, because it was the first year they couldn't do the beginning inventory, but look, here's our cash, here's our inventory, here's our equipment, here's our liabilities. This all has a stamp of approval on it for the balance sheet. So it is something. It's giving them something that they can actually use with banks, investors, and that sort of thing. Even if you can't give it to them on the income statement and retained earnings and cash flows. Okay. Audit plan. The audit plan or audit program. Okay, this is a detailed, high-level description of what you're going to do. Okay, so risk assessment, audit procedures, and other procedures. We'll talk about those later. But it's a very detailed plan. And I think I told you this before. The audit plan or audit program that you'll follow, I found a lot of stuff when I was doing audit. A lot of bad. It wasn't because I was a genius at all. It's because there's an audit program. And if you follow the audit program, you'll find things if there are things that are wrong. If there aren't things that are wrong, you won't find them because there's nothing to find. But if you follow this audit program, now it takes some diligence sometimes to figure out exactly these audit programs, what they're asking for. So sometimes it's a good idea to ask your supervisor, okay, what am I actually looking for? I know I'm supposed to pull these invoices. I got that. I know I know how to do that. What am I actually looking for when I do these things? And get kind of a background. A lot of times your supervisor will kind of walk you through it anyways. But anyway, so that's what you do when you're, again, if geez, I don't know if I should do this auditing stuff because I can't remember all this stuff. You don't have to. There's audit programs that, if you follow those audit programs, a lot of times companies will have audit programs that they, go through every year. They change them a little bit as time goes on, but, usually, you kind of work your way into it. And I did auditing for about 3 years, and by the end of 3 years, I knew quite a bit. In the first few years, you're a little bit, the first year, I should say, at least, you're a little bit green, what are we doing? Why are we doing this? That kind of thing. But after a while, though, you get used to it. And so the audit program, it's very detailed. It'll say what you need to do. And usually what they do is they have them broken up by, they can do it by cycles, or they can do it by accounts. The companies I always worked with, we did by accounts. So there'd be a cash account. And they have all the list of stuff you need to do if you're auditing cash. Accounts receivable, they'd have a list of all that. And along with that, they would have the testing from the previous year, a lot of times would be in there. So you kind of have some idea of what to look for. You go back and look at it, and usually you can kind of figure it out from there. So don't think like that you have to memorize, here's the 28 steps for auditing cash. That's not required on the CPA exam, and it's not required on a job either. they'll generally have some kind of a program for that. And you can always Google it too and find there's a number of samples of different audit programs that you can find for auditing cash and inventory and all that kind of stuff. So don't think like you have to memorize all this stuff. And a lot of times, how do you find stuff? You don't generally find stuff because you're a genius. Well, you probably are a genius, but it's usually because you're diligent. You go through the steps, and here's a problem because I followed the steps, and it kind of indicated that whatever. So, but that all comes in the audit program, and they're very detailed because they say, okay, here's the risks. We have to test for those risks, and those are all written down, written procedures. I think, do I talk about this later? I'm sorry, I'm going to jump ahead here. I gotta. For some stupid reason, I don't talk about this later. Okay, let me talk about it now then. Okay, risk assessment. Man, I thought I did that. What more on put this thing together anyways? Okay, risk assessment, you always do a likelihood and amount. Example would be, let's say that there's a 40% probability that there's a $400,000 misstatement. So we'll call this risk A. And then we'll have risk B. You can't still just have risk A. All right, so risk B is that there is a 2% chance of a $5 million misstatement. Which one of these is more significant? Which one of these are you more likely to test for?
A.
Yeah, A. It's much more likely, pretty good chance it's going to happen. It's not as big a dollar amount, but it is, quite significant, quite likely it's going to happen. And if you multiply these out, what's 40% of 400,000? 160,000. So that's the overall risk of it. What's 2% of 5 million? 1% would be 50,000. So this is, and the overall risk for this is actually even less too. So the 40,000, the 400,000 is the bigger risk of this thing. And you'd probably spend a lot more time with this than this one that is fairly remote. Yeah, it's a bigger amount, but it's not likely. This one is actually sort of likely to happen. Okay. And audit procedures. Once we figure out what the risks are, we say, okay, how do we test those? And so you start with the risks. So you always start with this, the risks, which are probability times dollar amounts. And by the way, this is one of those things that after about like a year auditing, I would sit around and we talk with my supervisor and maybe say, okay, what could go wrong and how much would it be? And you sit there kind of brainstorming, this contract's a mess. We got to look at that, because that could be big dollars. And so we would go around and around and see which ones are the most important, and those are the ones that we would test. And the same thing for external auditors. where are the risks? Okay, we found the risks. We found the things that we want to really make sure, we tie up. And then we go, okay, how do we test that? Okay. So this is actually comes out of the risks. Okay, a tentative audit plan is developed for their initial risks. So, okay, we found out what we think could go wrong. And this tentative plan may require frequent modifications. As you do your testing, you might come up with ideas that, oh, this isn't a problem at all, or, oh, look over here, this is a mess, we got to look at that. Okay, so this is highly detailed, and it's targeting these risks. And so the plan is, so these are the characteristics of the audit plan. Yes or no? Is general in nature? Yes or no?
No.
It's very specific. You're testing for a specific, not just a specific test, but also a specific risk. Is a detailed list of audit procedures? Yes. Yeah, it's gonna be very detailed and is, hey, I bolded it, I didn't highlight it. I'm gonna bold all these. Okay, so is general nature? No. It's is detailed? Yes. Can be changed once the audit is started?
No.
Actually, I'd say yes. If you are doing an audit, you start figuring out that there's a problem somewhere, or if you figure out that there isn't a problem, you thought there was a problem, there's not, you can change the audit. And it's basically based on reassessing, these risks. Is based on risk assessment.
Is that a yes?
Yep, it is a yes. Yeah, so you assess the risk and then you say, okay, how do we test it? And again, it's sort of a, it's guidance at the beginning. There's almost always something that comes up during an audit. You have to change it a little bit, but even then, it's changed based on the risks. Good or bad. You might find something that's a mess. You might find something that you think is a mess, or was last time was a mess, and this time it's perfect. You go, okay, well, let's not waste a lot of time with this. Okay, E is the same for all clients.
No.
Nope. It is not the same for all clients. Every client is different. Every company is different. So every client is different. Every company is different. Oh, I'll tell you my favorite. This is a fortune cookie. There is no such thing as an ordinary cat. This is absolutely my favorite fortune cookie thing we ever had, and it's true for so much stuff. There's no two companies that are alike. Target is different than Walmart. Yeah, they're big retailers. Okay, they're similar, in that sense. They're completely different. different rules, they have different clientele, they have different merchandise, they have different policies and procedures, they have different, everything about them is different. Yeah, they're big retailers, but that's where it ends. They're completely different, different sizes. And the same thing is true for every single company. Same thing for every single person. There's no two people that are alike. Even you get twins and they're different. Identical twins will be different. There's no such thing as an ordinary cat. They're all everything is different. So there is not going to be a one way to do it. Now you might do certain procedures for different clients that are the same, but you will not do the same audit maybe changed for revised risk assessment.
Yes.
Yeah, if you find something is more of a problem or less of a problem, you definitely will change it. Okay, let's see here. I'm gonna get I'm trying to get these on the same page. We'll finish this page up at least. Okay. Hey. Oh, that is it. Okay, you are required to get an understanding of the client's business environment. It is required that you do this by the AICPA. Okay, now you look at how you get an understanding of it. You'll notice that some of these are not exactly what we're used to doing as accounting people. When we say inquiries, what's that? You inquire about something. What are you doing?
Asking a question.
Yeah. A tremendous amount of auditing is asking questions. Well, how exactly do how exactly do the cornflakes get into the box? I see how you make the cornflakes, and there's about, a lot of times you'll ask these questions about, inquiries of management. You'll talk to people, and you get kind of good at it. I'm a very much an introvert. I got a bizarre field, and even more bizarre that I'm teaching, but you just get used to it. You just get used to asking questions. Well, okay, how do you know this? Well, okay, so what if something isn't, shipped completely? How do you determine where to make the cutoff and send the invoice? You start asking questions like that, and and you wait for their answer of what they do. So a lot of it is inquiries. It's asking people questions. Analytical procedures, see below. Okay, we will wait for analytical procedures. Here is another one that doesn't sound very scientific. Observation and inspection. Their activities, their operations, documents, reports, and premises. So you will be observed. You'll be looking around. Now, well, let me wait. I'll wait to the end here. Okay. Other procedures, such as inquiry of those outside of the company. So you're also going to talk to other people. Big ones are legal counsel. You talk to their lawyers. They talk to their banks and stuff like that too. And reviewing information from external sources. Banks are a big one. If it's publicly traded, you'd have a analyst and rating organizations, business publications, things like that. So external sources, going through the stuff, getting an understanding of what they're up against. Okay, now let's rank these as far as which ones are the best. The best one up here is this. And you might say, well, that's kind of odd. But observation, inspection of client activity and operations, this is the best of these up here. This down here is in ML, D and E, external sources. These are, say, second best. But as far as evidence is concerned, this is the best evidence. And you need to have evidence of understanding of the client's stuff. And you say, well, okay, why? Why is that the best evidence? The stuff that you ascertain for yourself is more persuasive than what somebody else tells you. They can tell you anything, right? You do an inquiry management. How do you determine when to cut off the invoices? When you're shipping stuff, and an order is 90% filled. Is that when you ship? Is that when you cut off for the invoice, or when do you cut off for the invoice or whatever? And they might tell you something. Oh well, we do blah 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 blah. You write it all down, and then you go observe it, and it's completely different. What you actually see is more persuasive, and you ascertain for your own work. So if you do calculations on your own, they do their depreciation calculations, and let's say that you say, okay, what method are you using? Okay, I'll do my calculations. Your calculations are more persuasive. So the stuff that the auditor does for themselves is more persuasive than what they're told or what they're given by somebody else. Right? So your own calculations are more persuasive. And I can't tell you how many times, that in fact, I think by the end of the time I was doing auditing, I pretty much would just go observe. And I would observe by talking to people, and while I'm talking to them, I'd ask them, "What do you do? Why did you do that?" They'll say, "Oh, well, I did this, that, and the other thing." And sometimes, I remember when I first started, and I would do the inquiry, that I'd look at the procedures that they'd have written down, which were crazy. But then I'd talk to somebody, and they'd say, "Oh, you do, we do X, Y, and Z." You go observe it, and it's completely different. And you come back to them and say, "Well, you said it's actually done like this." Oh, really? Oh, I didn't know that. Oh, I thought it was done like, a lot of times, they're not trying to be cagey or underhanded or fraudulent or anything like that. They just don't know. Sometimes they'll tell you what they think you want to know. If you ask them, "Are you doing this?" and they say yes, and you go, "Oh, that's a problem." They go, "Oh, well then no." Sometimes they're just trying to figure out what you want, rather than really answering the question. So inquiries can be a little bit tricky, and they should always be taken with a grain of salt. And when they tell you something, it kind of gives you a heads up where to look. Okay, well, I'll go observe this, and see what is actually going on. Sometimes it's exactly like what they say. There's a number of times that I was doing auditing where it was very different than what they were saying. So anyway, what you figure out for yourself is more persuasive than what somebody hands you. Okay, think of that as kind of like secondhand. Okay. All right. Let's see here. Yeah. Oh, I do have the risk thing here. I'm an idiot. Hey, look, I used the same numbers. Oh, no, I didn't. They're close. Okay, we'll go through this. This shouldn't take more than a couple. I'm going to stop here. Well, let's do these here. Analytical procedures. Analytical procedures are plausible relationships between numbers. Okay, so this is an example of an analytical procedure that you might do. So these are just some of the counts of from this company, whatever company they are. And they have their information for 2021, 19,800,000, and advertising expenses 825. 2022, they have 22,000 in sales and advertising expenses 610. What is unusual about the above information? So what is unusual about these numbers that we have here?
It's in 2022 the sales is a um solid number. I mean,
Yeah, no, you're right. You're right. It is a little strange that they're usually 22,523,000, whatever. But yeah, that would be unusual too. What I was looking at more for though here, and you're absolutely right though. Yeah, big round numbers are unusual. That their advertising expense went down, and yet their sales went up. Usually, that's not the way it goes. You know, how do you make more sales? You advertise more, or you give more promotional stuff out, or if nothing else, maybe you pay more sales commissions. Okay, so what's unusual is that sales increased. It is true that they're nice round numbers. That's also a unusual thing. I gotta redo this. And advertising decreased. So this is unusual. Now, is this absolute evidence of fraud? Are we going to go get the handcuffs? What do you think? Generally speaking, analytical procedures are not going to find um, material misstatements. Analytical procedures aim you in the right direction. They say, "Hey, this is kind of weird. Why don't you go look at that?" So that is what analytical procedures do. They are not generally evidence of misstatements or fraud or anything like that, but they tell you where to look. And you have to go get evidence that may indicate that it's fraud or whatever, but they really just tell you where to look. They're not evidence in and of themselves, usually. It could just be that they found a more efficient way to advertise than that, or maybe they found you got a really big customer or something that's buying a lot more stuff from them. It could be any number of things. But just because when the sales go up and the advertising expenses go down, that could be a problem. But it doesn't not necessarily mean that it is a fraud. It could just be part of business. We got more efficient or whatever it was. Now the question is, well, okay, so what could be the problems? And the problems could be either sales is too high or advertising is too low. It could be that one is too high or one is too low. So that would be what you'd be looking at. Okay, are the sales overstated? If they're not, then is advertising understated? Maybe they're not telling everything. I just bored myself. Big yawn. Okay, and I think we talked about this one already. In fact, I think we already picked this one. Which one of these is the most interesting? And just like I said before, it was B. And not just because it is more likely, it has a larger anticipated, um, you multiply these out, it's a larger. But also, you look at these three items, $5 million is a risk, that's only 1% chance, okay, that's pretty remote. 400,000, 40%, that's pretty good likelihood. And it's a significant amount of money, depending on how big the firm is. And C, compared to the other two, yeah, it's almost certain that it's going to happen, but it's only $5,000. So even though it's very likely, the dollar impact of it is not that big compared to the other ones. So B would probably be the one you'd be the greatest concern with. Okay, and we're going to stop right here. Okay, and we come back, we're going to do the pick up on the sampling. Okay, so let's say be back at, oh man, I'm going late here. 7:19. Sorry about that, guys. Yeah, I'd be talking to myself right now. I don't know. That's enough of that. All right, so be back like 7:19. We should be able to finish this up. This isn't too bad. Okay. Okay. Allowance for sampling risk. Sampling risk is the risk that the oops. Uh, so sampling risk so that it will not be approximate or be representative of the sample as a whole. And the allowance for sampling risk, this is one of the ways we measure it, and it goes by standard deviation. Now, the more accurate you want to be, given the same sample, the more accurate you want to be, the greater the sampling risk. You know, so if you want to be 95% sure, your sampling risk will be plus or minus 10. This is kind of like your basic statistics. You know, each one of these is a standard deviation. So if you want to be 95% accurate, it could be minus 10 or plus 10. That's to be more accurate. If you want to be 99% sure, it goes up to 15,000. So now it could be plus or minus 15,000. So if your sample was, say, the projected balance was 100,000, to be 99% accurate, it could be as low as 85,000 or as much as 115. So given the same sample size, lower sampling risk will have a higher allowance of sampling risk. So the allowance will be higher, the dollar amounts will be higher. So if you want to be 99% sure, you're going to have allow for a higher amount of allowance. Now you can reduce that by increasing the sample size. And that's just in general, you can reduce the allowance. It's sort of like, you know, the more items you think about that bell curve, right? The more items you pick, that bell curve kind of gets squeezed into wherever it's going to go, you know, more. And at some point, you get to 100%, you'll know exactly what it is. But the higher than that, you know, that bell curve moves in, and so the actual allowance for sampling risk, the dollar amounts, will get smaller if you take a bigger sample. So you can reduce it by getting a bigger sample, but also if you try to be more accurate with the same sample size, you have to spread it out because you're trying to be more sure of it, and there's more possibilities that it could be out further. They test that a little bit on the CPA exam. They'll have multiple choice questions on that. So the lower the sampling risk, larger the allowance for sampling risk. Okay, test controls. They actually test this more than they do at least in recent years, I think they test this more than they do the substantive testing. And the question is, can you rely on the controls? So relying on the internal controls. And these are yes, no tests. I think we talked about this. So for example, here is the control. The control says that requires 2 managers' signatures on checks written for more than $5,000. Okay, so maybe that's one of their controls. By the way, why would they have that control? If there's a check for more than $5,000, they have to have 2 signatures on it. Why would they do that? Anyone? Hey, you guys are sleeping, aren't you? You turn your mics on. I can hear you snoring. Why would they have to have 2 signatures on a check? Why would that be a control? I'm not sure if you guys are even here. All right. Well, it's the idea is that for especially for larger dollar amounts, you have more than one person has the ability, is informed on it. It takes 2 people to look at it, and so that they will look at it, and if there is a problem, at least one of them will say, "Wait a minute, why are we doing this?" or "This is too much," or whatever. Okay. Now, auditor would take example checks written for more than $5,000. And each check would either have 2 signatures or not have 2 signatures. So either 2 people sign it or they don't. So yes or no. The auditor will allow for an error rate of 7%. Let's bold that. Let's make that green. The allowance for sampling risk is 2%. Okay, so it's that's that kind of bell curve thing. That how far out can it go? It can go out 2% on each side. Now remember, this isn't dollar amounts because these are yes, no tests, it's a percentage. So they're saying, okay, it'll be 2%, it can be 2% off from what we think it is. Okay, and the allowance for sampling risk is 2%. So if the error rate is 7% or less, we're okay. If it's more than 7%, we're not okay. All right, what is the error rate for this? We picked 200 checks and 6 of them did not have 2 signatures. So what is the error rate of the sample? Anyone? All right, we'll sit in awkward silence until someone comes up with this.
Do you divide 194 divided by 6 and
Close.
find the rate?
You probably do the 200. Say, okay, out of the 200 checks, 6 of them were bad. So the error rate would be, what is that? So the errors were 6, and the sample was 200. Oops. All right, so that equals 3%. I think it's 3%. I don't have my phone with me. 6 divided by 200. That's 3%. Okay, so the error rate is 0.03. I know how to do this better. Okay, so it's 3% is our error rate of the sample. Now, this is our best estimate as far as what the true error rate is, but it's a sample. So we could also have this allowance for sampling risk. Now, it could be plus or minus 2%. We're worried about the plus 2% here because that means the error rate is worse. So the upper limit on it equals 3% plus our allowance of 2%. Oops. Okay, so this is the key down here. So our upper limit is 3% that we found for our error rate, plus we have an allowance, it's a bell curve, right? And so we're saying that the upper limit on this is 5%. Now, the auditors allow for a rate of 7%. So are we going to rely on the internal controls? We're okay if it's up to 7%. Our upper limit is 5%. Will we be okay relying on the internal controls? What do you think? So according to us, the worst that this could be, at whatever percentage we're talking about, they don't tell us what percent, but that it could be off by as much as 5%. And we'll accept it if it is at 7% or less. So would we rely on these internal control? Would we rely on the controls?
Yes.
Yep. Yeah, it's less. So yeah, we would rely on the controls because we're saying, okay, the worst case scenario, it's 5%, and we'll accept it even if it's up to 7%. Oh, someone already put it in the chat. I'm sorry. Yes, you did. I'm sorry, Maritza. Yeah, we rely on it. Okay, so again, these are test controls, and this gets tested as much as the other two combined, pretty much. The oh, drawing a blank. The classical sampling or the monetary unit sampling. This test of controls, and you're doing these tests of controls because you want to rely on the controls so that you can reduce the amount of testing that you do. So that's why we're doing it, is so that we can rely on the controls, we can reduce the amount of testing overall. Okay, now there is this problem though. Let's grab some space up here. Okay, so this side is sort of like the auditors, assessment of internal control. And this is what, oops. And these are the actual numbers that you won't know about. So this is the actual effectiveness of the client's internal controls. So here we did our assessment. So for instance, up here, let's say that this, we thought that this was adequate. So this is a, this would be like our 5%. We thought, okay, this is adequate. So we will, and let's say that in real life, the actual is adequate. So this would be sort of like the correct answer, right? We thought they were adequate. They actually are adequate. So our sample came up with that it's correct. And same thing if we would have came up with that it's inadequate, right? If we said that they were inadequate and the controls really were inadequate, this would be the correct decision too, right? It's what actually, here's the actual, and here's the auditor. So if these two match, that's good. That's exactly what we kind of want to have, right? Okay. Now, the problem comes in these other two. So inadequate. Let's say, or I'm sorry. Let's say that we came up that it's inadequate, that the controls are inadequate when actually they were. Okay, so we thought that the controls were no good. Let's say that our sample came up that we, of an upper limit of 9 or 10 or whatever, and we're only accepting if it's 7. Okay, we say, okay, we can't rely on these controls. We'll have to do something else because we can't rely on the controls. That is called an incorrect rejection. Now, we could have also the other problem, and that is we think it's adequate. We come up in our test, let's say it's 5%, and maybe the actual controls are off by 15% or whatever, that we shouldn't be relying on them, even though we were. This is an incorrect acceptance. So those two are the problems. Which one of those two is more dangerous? Is it more dangerous to, okay, we have let's take this one, the first one we did, incorrect rejection. We say, okay, these controls aren't very good. We're going to have to do something else. We're going to have to just do a bunch more testing of the dollar amounts. Or is this one more that we think everything is okay when it's not? So which one is the more dangerous of the two, the incorrect acceptance or the incorrect rejection? Oh, see chat. Yeah, well, actually, the incorrect acceptance is the one that is the more dangerous. Incorrect rejection means that we'll have what they call an inefficient audit. We'll do more work than we need to do. Incorrect acceptance is the more dangerous one. This is an ineffective audit. We think everything is okay. When it's not. So this one is the more dangerous of the two. This is the one that auditors fear. This incorrect acceptance. Incorrect rejection just means, okay, we'll do more work. And eventually we'll come around to, that, the controls are okay or whatever. But this one is the more dangerous one. This incorrect acceptance, because you think you're actually thinking that the audit is fine. Hey, we did. Hey, I don't know, worked out great. Everything was fine when it isn't. You're not looking for, and it comes because of, that bell curve. And if you think about it, let's say you audit to the 95% level. That means that 5% of the time you're going to be wrong. It's statistics. So if you audit to the 95% level, 5% of the time you're going to be wrong. So that's 1 out of 20. So 1 out of 20 times, you're either going to think that, oh, these controls are terrible, we can't rely on them, we got to do more work. It's going to be inefficient. You do twice as much work as you needed to do. Or the more scary one is you think everything is fine and it's not. So that's the more worrisome one, is the one that is where you are blind kind of to the fact that you can't rely on these controls. So, or unaware maybe is a better term for it. So being unaware is far more dangerous than, oh, we got to do more work and, we did too much work, more work than we needed to do. But that's part of auditing, is that, it's, it is possible that, 95%. Same thing goes for the substantive procedures. And these are the ones that we did before. Why I got these kind of classical sampling that we did, mean per unit, ratio estimation, difference estimation. But we have that same kind of a matrix thing down here. And so if we think that they are not materially misstated and it is not materially misstated, this is correct. I'll leave it up here. Or uh, let's make that yellow. The hardest part about auditing is knowing the colors to make things. Okay, so if we think that they're not materially misstated and they're not materially misstated, that's correct. Or if we say, okay, these financial statements are misstated and they are misstated, that's correct also. Oops. And this really leads to the same thing. Incorrect acceptance and incorrect rejection. And again, this one is ineffective. And this one is inefficient. And so this one, you'll think that you have a material misstatement, and through further testing and whatever, you should come around to the correct answer. This one, you think everything is fine, and it's not. And so this one will end up with an undetected material misstatement. And this is every auditor's nightmare. Undetected material misstatement appears in the financial statements. By the way, this one, this substantive procedure one, this one is more dangerous than the test of controls. So test of controls is less dangerous than substantive procedures. And I think I mentioned why before, but I'll mention it again. If you're doing the dollar amounts, that's what ends up in the financial statements. You can have weak controls or significant control deficiencies, let's say. You can have those, and the financial statements can be fine. Okay, the controls are bad, but the financial statements are fine. A problem with the internal controls does not necessarily mean the financial statements are materially misstated. But if you miss a material misstatement, the dollar amounts, and it goes on the financial statements, that's the problem. That's what you sign off on. That's what you say, give the whole thing, the whole spiel. We believe that our audits provide a reasonable basis for our opinion. In our opinion, the financial statements present fairly in all material respects, blah, 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 financial position and whatever. So that, the dollar amounts being off, the second one that we have here for the testing of the substantive testing, those are more dangerous to have a problem with, because that's when the actual audit is ineffective. Any question on that? Okay. Now, suppose more of this. Suppose initial test of controls indicate. So this is kind of separate from what we just talked about, but it's a key thing. Suppose the initial test of controls indicate the controls cannot be relied upon. So we can't rely on the internal controls. We want to rely on the internal controls because it can reduce our substantive testing. But our tests show that, we get into it, let's say we get, 10 or 20% into the testing and we find out we can't rely on them. So we cannot rely on the controls. Are we going to increase the test of controls or increase the substantive procedures? Which one are we going to rely more heavily on? We can't rely on the controls. So let's say that we're testing the controls and we find out they're just a disaster. Things aren't approved correctly, things aren't being reconciled, and all kinds of stuff. We want to rely on the controls, but we can't. So what are we going to do next? Let me ask you this. Are we going to still test these controls we can't rely upon?
No.
No. So if this happens, what you're going to do is increase the substantive procedure. So when you get into, we can't rely on these controls, well, stop testing them. Don't waste any more time on them. You're not going to be able to use them anyways, to reduce so just increase your substantive, the dollar amount. So, so for example, so maybe your plan says that you need 500 items for substantive testing. Oops. I'm sorry. Take 1,200 items or whatever it is. So, you're going to increase your substantive testing. Say, look, forget about the controls. We're not going to take 500 items. That's not going to be enough. We wanted to rely on the controls, but we can't do it. So we'll bump this up to 1,200 or whatever amount you think is you're going to need to go to. When we talk about the test of controls versus the substantive test, the relationship is inverse. Oh, the relationship between test of controls and substantive procedures, add this on. Is inverse. The more of one you take, the less of the other you do. So if the test controls are going well, you're going to do more test of controls and less substantive procedures. If the test controls are a disaster, you're going to stop doing the test of controls. You can't rely on them anyways. And you're going to do more of the substantive procedures. So the actual relationship is inverse. Question on that? And with that, we can turn this one in. That's Zoom. You guys probably already knew that. Okay. So that'll be it for today. So we can turn that one in. We're still working on the chapter 6, which chapter 6 is a big thing. So I'm not worried about that. Argue when you're doing an audit, chapter 6, along with chapter 5, which we'll cover a little bit, those are probably 80% of the audit. So I'm not worried about spending extra time on those two. Okay. Questions? Is that enough? We're 5 minutes early, so let's all put our heads down for 5 minutes and then we'll leave. Or we can just do it now. All right, so turn in the sampling overview. I'll make sure that I have that up. If you have not got the test in, see if you can get that test in chapter 3 exam. And most of you have already got it in. But yeah, and so we'll turn this in, and then next week we should finish up chapter Yeah, we should be able to finish chapter 6 next week and probably get at least a good chunk through chapter 5. I think I got chapter 5 pretty much cut down. We covered a lot of it. They kind of go hand in hand. Okay, any question? Is there something else we need to turn in? No, just the sampling. And if you already have the, you can't see what I'm doing. I'm so sorry. Just this, turning this in, the chapter 6 test handout we're not done with, so we won't turn that in. And then if you have not turned in the exam, the chapter 3 exam, see if you can get that in. And I will get the extra credit points for those posted shortly. Okay. All right. Have a good evening, and I'll see you guys in a week's time.
Thank you, Professor.
Have a good one.
Thank you.